Hi, everyone. Welcome to the weekly stock market update. I have, as ever, got a lot of insights for your pension, why your pension's been underperforming, and what to do about it, and just getting into savings and investing generally. So let me share the screen and let's start straight away. You should be able to see and hear me loud and clear. Please let me know, as I always ask you, where you are from, and I will, as we go through it, I will, during the course of this, answer all of those questions. We've got New Zealand in the house, as they say, here today, and Manchester's covered as well as, so we've got UK at least, and we've got Pinner and Swansea, so we've got Wales covered as well. Thank you all very much. I'm going to start a poll. We'll start that straight away. And more importantly, let's get on with it. You will need a camera to record some of the things. Also, what I want you to tell me is if this is your first time. Now, what you can see on screen, you can see the most held stocks by hedge funds. I will share my views on these as we progress during the course of the call on the market update. Okay, so you're going to get more of this as well. And like I said, let me know you can see and hear me. I suspect numbers today are going to be a little bit limited because, well, there's an England match coming on soon, so they're all probably getting lubricated. July tends to be the best month in terms of consistent wins, and the second best month in terms of returns. November gets the best. Now, that doesn't mean it's going to replay itself or repeat itself. This is just for information. It's too small a sample size to be based just purely on what you can see on the screen and just to use that. Like I said, let me know that you can see what I can see on screen as well first time. Dean, thank you very much. Now, one of my students said, there's an elephant in the room. I didn't know I was in the room. And the elephant in the room, he said, is that there's only a few companies which are pushing up the S&P. So the S&P is up 14.65%. NVIDIA represents 5% of that. And Microsoft, 1% of that. After NVIDIA and Microsoft, nothing contributes more than 1% of that S&P 500 return. There is another element to this, which is are only a few stocks, the ones leading the charge. Now, what's interesting here is whether they're tech or not. Well, Berkshire Hathaway isn't tech. Eli Lilly, is it tech? Is that actually the overlap with the most held stocks by hedge funds? Coincidence? Obviously not. They're in the business of making money. And we've got a big incentive, which is we get paid 20% of the profits, usually sometimes more, but in our case, 20% of the profits. So we've got a huge incentive. Now, that raises another problem. Should you own these? Shouldn't you own these? What's happening to the others? And we'll come to all of that in this as well. Year to date, a hell of a lot of green. This is the S&P 500. As you can see, there is a heck of a lot of stocks which have gone up. And many of these have made all-time highs, not just the ones which have contributed to the S&P 500, because the S&P 500 is based, its returns are based on the market capitalization of the company. So bigger the company, bigger the move. But you don't care whether it's a big company that goes up 100% or a small one. What you care about is getting the ones that do. And as you can see, phenomenal returns so far this year. And even if you're throwing darts at a dartboard, there were quite a few. What about the others? What about the Nikes of the world or Starbucks, which are down substantially? Well, should we be looking at some of those? Should we be patient? How patient should we be? I've given many examples where Microsoft has had a 60% return year and yet spent 6 months of that underwater or producing a 0% return. So certainly there is an element of patience in all of that. Somebody said it did say 5 p.m. It did indeed, Peter, say 5 p.m. Good morning from Auckland, New Zealand. Oh, I'm so sorry, you're from New Zealand. And it's 5 p.m. UK time, which means it's really early or late for you. But thank you for being on here as well. Now, FTSE 100, how many of you think it's going to be high by the year end? Well, quite a lot of you by the looks of this, which is pretty impressive, actually, how many of you do think it's going to be higher. I will close that poll so I can share it. 57% of you think it's going to be higher at the end of 2024. Who am I to disagree? Let's do the same with the Dow, shall we, as well? 4 a.m. Peter, you are a loyal follower. Now, let's have a look at what I said last year. Goldman Sachs thinks this is going to be like 1995. If it is, then the party's going to continue. And we certainly don't want to be waiting on the sidelines. And we certainly don't want to be waiting on the stocks which aren't doing well. Okay. What we'll also discover in this webinar and discuss in this webinar is UK pension plans overpay £1.5 billion in fees to fund managers. Yep, that's right. Whoever your pension plan is with, they are paying fund managers. It's corrupt. Okay. They are paying a hell of a lot of money in kickbacks. So maybe it's lovely dinners in the city, drinks, booze, and all the rest of it. Analysis reveals some schemes pay up to 14 times more for the same product than rivals. And there's an article about this in the Financial Times. I will go into some of the problems with pensions. These are the returns from one of my students. Now, this student didn't quite listen to everything I said. He took more risk than I wanted. He got into products which I said, well, I'm not so sure, it's a bit risky. He was fine with it. What I will say is sometimes I have students who will follow all the information I have and they will use that information to make their own portfolios. And that's fine if they wish. They might be happier going on if he and I went on a roller coaster ride. He might be happy at the faster speed one. And I'll say, that's not for me, it's for you. Anyway, we will cover these stocks as well as we go through the webinar as well and some of the returns if you're willing to take this level of risk, which is more risk than I'd take, and I try and talk people out of it. So what am I going to say? This is not individual financial advice because I do not know you individually, okay? That's the point I want to make. So let's dive right into the update. Point number one, how long does it take to double your money? That's really what we're talking about when we're talking about stock market updates. That's one of the things that we really want to know. 15% per annum means in 5 years you should double your money. All right. The average annual return since 1928 for the S&P 500 is 11.5%. So we want to do a bit better than that. However, the S&P is up 28% since October the 27th. I've got 3 times leverage on the S&P 500. I've also got the index tracker on the S&P 500. Now, why would I have that if I'm going to cherry pick stocks? The reason is it's just in case I miss out. And also the volatility peak to trough on the S&P tends to be less because it's a collection of 500 stocks than individual ones. So if it's got lower downside volatility, then I want more leverage. Lower downside volatility, i.e. peak to trough falls tend to be limited, then I want leverage to the upside, because what's left, if downside's limited, then presumably upside can be, and we can just look at the chart, can be bigger. So I want that. So actually just having 3 times leverage on this alone, and if I did nothing else, would have got me the 5 years to double the money. Actually, I want to try and do it sooner. And you might say, well, you're being bloody greedy. If you want to do it less than 5 years, you want to do it in 3 years. Yeah, if I can, I want to try and do it in 3 years. If we get a great year like 2023 and there's a market tailwind, then I want to do it sooner even still. But then you get years like 2022 where you're holding cash. Okay. One of the things that I want to, before I dive into it, reiterate is why it's important to have the option to hold cash. This is 2022. You need to be able to sidestep this entire asset class when the time comes, because otherwise you will, even in a stock like Meta, lose 63%. And that's why pension funds also fail you, because they can't hold cash. So in years like that, they remove half your pension, take you all the way back like snakes and ladders to 6 years ago, and you're screwed. All right? Because they can't hold cash. They can't hold cash. So even big names like Scottish Mortgage Investment Trust or Fundsmith end up being embarrassed. So why do they do it and never tell you that? Why do they not tell you that? Well, they do in their prospectus. If you look in the small print footnotes on page 56 of their prospectus, they will tell you that. Listen, they're getting paid too much to tell you the truth. It's a conflict of interest and it's a fraud by any other name, that they can't hold cash and get out of it. And your IFAs are in on it because they get kickbacks and they won't tell you that either. or they'll sort of tell you like this, yeah, we can't hold cash. That'll be it. And this is why underperformance is rife amongst active fund managers. They can't hold cash. I can, you can, big advantage we get to outperform them. We just, even if we miss half of that year, even if we just miss bloody half of that year, and we're not even talking about timing the market, we're talking about 1 in 7 years, just missing half of that fall, you can outperform a fund manager. Simple as that. Okay? How's the past week been? Well, for the market, it's been, not as good as the past year has been, because obviously weeks are going to be more volatile and extreme than years will be. So the past week has seen great for Amazon, which is one of our holdings. We'll look at Tesla in a second and see if it's a special situation to get back into. As I already previously said, it's a bit early for me, even though I said I think it might have hit bottom. But others, like my friend who I showed you earlier, did get into it and did 2 times leverage, which is richer than my blood. I wouldn't want to do 2 times leverage on Tesla because of the volatility, but he was happy with it. Apple will cover, Alphabet, Oracle will cover these as well. And you can see there's a lot of red elsewhere this past week. Don't read necessarily too much into it. Financials, my JP Morgan is doing fine. We'll come to that as well. Year-to-date performance, how are things doing so far this year? Well, so far this year, hell of a lot of green. Okay, you've got your Microsoft, your Oracles, Apples, Alphabets, Amazons, Costco, Walmart, the discount stores. For those saying it's just tech, I'm afraid it's not just tech. Walmart and Costco have been driving, doing rather well. So is aerospace, General Electric, so specialty companies as well. The energy companies are green, building as well, and of course the financials, a hell of a lot of green. Semiconductors, obviously computer hardware falls into more tech, have all been green, and healthcare, Eli Lilly, Merck, AbbVie as well. So we're going to dive deeper into these and ask ourselves, how the hell do we get our hands into it? Disney's up 9%, Netflix 39 year to date. How do we get our hands on these returns? That's what we all want to know as well. Felixstowe in the house, as is Buckinghamshire. You're all more bullish on the US markets than you are the UK for the end of the year. You think the Dow will be up. Remember, the Dow is not the S&P. Now, who will win the US general election? Let's see what you think about that. ETFs, well, it's been over the past month a torrid time for crypto, but for leverage, it's been good. I'll come back to leverage later. You can look at these in your own time because this webinar is not about exchange traded funds. Buy and hold blows you up. Now, those IFAs and pension fund managers who keep saying to you, oh, just buy and hold, Johnny, you'll be fine, because they give this as an example. Look, the price can drop and it comes back. Don't try and time the market. Well, that means over a 2-year period, you get 0%. I get that 170% return that the market delivered in this period. We sidestep this. It's really simple. It's a daddy bear. What's a daddy bear? When the monthly MACD, monthly MACD, the blue dotted line, crosses from a high position downwards sharply at a high gradient below its own moving average, that's a daddy bear. Get the bloody hell out of there and start holding cash. Okay. When do you get back in? Well, this was Meta. Well, for us, it's simple. It's one of the approved filtered list and quality 5. And the MACD wasn't falling. Excuse me. So you can get back in. Boom. When do you exit? If it falls X, sell Y. Simple. So you get that gain. You avoid that fall. Did I make it sound too simple? Well, it was a great case study of when the fire alarm drill worked, when being lighthouse watchman worked, when having home insurance process worked. Daddy Bear, quality 5, worked really well. And guess what? Over those 2 years, you get 0% if you buy and hold. That is why pension funds and IFAs always let you down, because they are taught buy and hold, buy and hold, buy and hold. Well, show them that. Ask them how they did in 2022. Ask them, can you hold cash? Right? All the things which screw up your pension. 190% second year. Year one. So they drag you down there. They might get you that possibly, and then they say, oh, it's all good because you got 0%. Nope, they've messed you up. They made you go through an enormous roller coaster of losing 6 years of your bloody pension as well. All right, so don't do it. Well, in the case of this one, the Blue Whale Pension Fund, 27%. Scottish Mortgage Investment Trust, 50%. So, secret ways I cheat to beat the fund managers, muppets like this. And there you go. People say, oh, you always show that one. Well, no, I've won competition in the Financial Times, that one, Bloomberg TV, and Channel 4. Okay. So I can show you those. And it's not just about competitions, because I'll show you what I do. This, you want ones with high sortinos. That's stocks that have a high average return and low downside volatility or risk of missing it. Fund managers don't know what sortinos are. And the stocks I'm going to show you are based upon this. So when there's companies that I say to you, well, I don't want to buy this, you can if you wish. This is why. If they don't meet my criteria, I don't care if I miss a company which might shoot up, because I'm not there to speculate. I'm there to make sure I've done the due diligence and I don't miss good things. Okay. Alpha, that means if the market falls, they go up more. If the market drops, they also don't drop as far. It's just statistics. It's just mathematics. You just look at the historic share price. It's not a guarantee to the future, but it's a bloody good guide to the future. How do we know that? Well, you can look at the statistical work of Richard Thaler or Eugene Fama on this, both Nobel Prize winning economists, as I have done and put into my books. I have put it into my books. I always give you a free copy of this book, which, by the way, has been reviewed glowingly by Peter Temple of the Financial Times, Bernard Opedy, a $2 billion hedge fund manager, Philip Hampshire of Bloomberg Television as well. Their reviews on the back. You're going to get a free copy. Now, by the way, 80% of you think Trump's going to win the US election. Who am I to disagree? Okay, so files. Let me share the book with you. Here you go. You should be able to get that as well. Now, you've got to be able to go into cash in years like 2020. If you can't do that, and funds can't, you're going to have a problem, okay? And like I said, you look to see if it's a daddy bear, monthly MACD. You need a few good companies, okay? Fund manager will tend to use a spray and pray. They'll put a little bit of money in everything. I stole my idea from Warren Buffett, put the money in a few good companies, and from Goldman Sachs Wealth Management with their 30% per annum formula, Croakey, and from Nobel Prize winners Eugene Fama, Daniel Kahneman, and Richard Thaler. And I've published all their work in my books. I've only copied what they do and taken the best bits from all of them. Never hold forever. Fund managers tend to buy and hold to reduce costs, because if they got in and out of those billion-dollar trades, they might get a bit screwed. The world changes too quickly to buy and hold. Just look at COVID. Exit if gains start declining. Cheap for me to exit, and you, because you're not a big fat fund. Okay, so again, that's exit if it drops XLY or if it's a daddy bear. Simple as that. Simple rules on when to cash or whether not to cash. Like if it's a baby bear, you keep holding it. And I'll show you this as well. Ignore stories and narratives. Follow the data. Follow the data. Fund managers love marketing to you and luring you on marketing stories. Don't do that. Make it bespoke to you. So as I said, my friend earlier, I showed you his portfolio. Okay. In his portfolio, I'll show it again. He had more risk than I'd be willing to take. Well, that's fine. That's up to him. But I didn't want to take that kind of risk, okay? And that's why, and I'm going to show you it in just a second. Here it is. Here's his portfolio again, which was like stonkingly good, done bloody good. Okay, that one, that's bespoke to him. That's bespoke to him, all right? So that's why it was fine for him, and if it's fine for him, that's okay. And you've got to make it bespoke to you. And the best way to make it bespoke to you, and I'm going to show you charts of this, is if it falls peak to trough, any stock, you look at its history, you can do it for free on something like a Trading View or Yahoo Finance, peak to trough. If it drops more than the percentage you're happy with, then don't buy it. Okay, that's one way to do it. That's how you work out your risk appetite. All right. I, for my own, is managed by me, not some bloody committee. Pick bespoke based on historic drawdowns, recovery times, 25% drop, 6 months to recover. For instance, any stock that doesn't meet that criteria, I don't want it. Right, and I'll show you specific examples of that in a second. By the way, on average, the first half of July is the best period of the year. We're halfway through it. The first 2 weeks in July and the lead up to my birthday are the best returns. So that's why I get many happy returns on my birthday. God, that's crass. But I do. Now, point number one, this is Microsoft. 60% return in a year. Okay, you can see it's a 60% return in a year, because if you look at one, you can see it went up 60% in a year. This is the year. All right, that's the year. It went up. 2021, I'm giving as an example. Point number two shows you that there were 4 months where it did 0%. Point number three shows you there were 2 months where it actually dropped 9%. So 4 plus 2, 6 months. There were 6 months where it gave 0 or negative returns in a year with a 60% return. If you can't look at that and understand, oh, that's actually how prices move, then you've got a problem and you've got no point being in the stock market, because that's why you end up losing 60% returns, because you panic during the 0% in 4 months. You panic when for 2 months it's going down and you lose your 60%. Whereas most of the time, Warren Buffett and I just sit back and watch. And we knew it was a baby bear, i.e. any falls and declines can be ignored because the MACD was not falling on the monthly. So we could just look back and go, yeah, it'll come around, don't worry. Okay, that's what you need to know and take away from this. It's incredibly, incredibly important that you do that. I want to share, if I can, this next poll, except I can't do it. For some reason, it's not coming up. Oh, there we go. Publish. There we go. So that should be up there. Thank you. Still gets his commission. Time for Leah to... Yeah, I think so. Eli Lilly might be right up there. Now, the way I pick stocks and the ones I'm going to talk about today in the webinar, they've gone through my value, growth, income. We know this from the Nobel Prize-winning economist, that valuation is more important than growth, is more important than income, but they're all important. They all weigh in future stock price movements. However, fund managers are idiots because they'll try and flog you a value fund or a growth fund or an income fund. And the reason they do that is because they can sell you more and more products at different variable prices and they can maximize profits. There is a massive conflict of interest. Same with the IFA. They'll get more kickbacks from one growth provider compared to another value provider. So why not sell you fund A from him and fund B from him, maximize their commissions, okay? Croakey comes from Goldman Sachs Wealth Management, Sortino and Alpha I just explained. High average return, low risk to the downside. Market goes up, they go up more. Nothing's guaranteed to repeat itself in the future, okay? But at least we've done the due diligence, ticked a load of boxes to make sure that the reason, if ever we're not performing as we wanted, is not because we didn't do the due diligence. And then I do that across 10,000 stocks. So let's look at some of this. And by the way, I take the view of Jim Simons, absolutely legendary hedge fund manager, $100 billion in trading profits. Okay, I have no opinion on any stocks. The computer has its opinions and we slavishly follow them. That's me. People ask me, what do you think about this? What do you think about that? No, I don't. The computer's telling me this and I share that data with other people. So like I said, there's 3 types of falls. When markets are going up or your stock's going up, you don't need me, you don't need anybody, you don't need anything. Okay, when it's falling, this is when you need people. So if it's a baby bear, like 0.3, that's the monthly MACD rising. Mama bear is where the MACD monthly is falling. And you might take, say, up to 30% of your position off. Daddy bear is 0.1, where the market's falling sharply and you want to go into cash, i.e. the monthly MACD from a height is falling through its moving average at a steep gradient. Got it? Is it daddy bear, mama bear, or baby bear? That's what we're going to talk about. Now, how are the valuations at the moment in the markets? The Microsoft, you're paying $34 for $1 of profits. Forecasted profits, but these expensive stocks are the ones which are doing well. Cheap is finance, cheap is finance, cheap is healthcare, with the exception of Eli Lilly. Cheap are industrials, utilities, energy, telecom services. However, valuation doesn't move stock prices alone. If it did, these companies wouldn't be the ones like Nvidia doing the best. Growth, for instance, is incredibly important. So we're going to look at all those factors. Now, next 7 days, earnings calendar. There's a hell of a lot coming up in the earnings calendar. It is earnings season yet again. And which are the ones which might move the markets? JP Morgan, Citigroup might move the markets. Goldman Sachs might move the markets. United Health Group may well move the markets. These are the most important ones to keep an eye out for. The others probably won't make a difference in case they have anything surprising coming out. All right. Over the past year, this has been performance. And what are you looking at? Whoops. Well, some sectors are doing obviously better than others. I don't care which those sectors are. I know utilities, you could barely go wrong picking anything in utilities. But if the company doesn't meet my criteria, then I don't just pick on the basis that let me gamble on a sector and hopefully that sector will be a really good one where anything I pick goes up, because that shrouds and disguises and hides bad companies. Because what happens if the market falls? Then my rubbish utility company, which has been rising because in a tailwind, everything rose, falls back the most and crashes because it just rose on the tailwind of other people's performance. No, I need a good quality company. I need, the reason it's rising is not because it's just hiding amongst a high performance team. I need it to rise because it's a bloody high performance company. Do you see? So those who say, oh, I think I'll gamble on a sector, idiots, all right? Instead, value, growth, income. We need the company to be a high performer, not just the team. Because when the team falls apart and the markets give a headwind, then those companies hiding amongst quality will fall further and you'll lose everything you made. Over the past week, where have we gone? Well, it was the expensive companies because valuation alone doesn't move the markets. In the past week, most of the money has gone there. So let's dive deeper into some of those. And I said ETFs over the past month as well. Year to date, NASDAQ is up 21%. I've got 3 times leverage in that and the index tracker, just as a sort of sweep away anything that I might have missed on individual stocks. 3 times leverage on the S&P, just in case any of the individual stocks I have didn't quite do great. Well, at least I've got 3 times leverage and the underlying. Okay, so is my son in his junior ISA. Now, this is how most funds move, most investments move. Delight, despair, delight. If you started investing in March, well, late February, March, or start of April, okay, you will have despair first before you eventually get some delight. If you started in January, you will have delight, and then you lose everything, then it comes back. DDD, it is going to happen to you. For those of you who think it's going to be like this, you're wrong. Different stocks will go through different cycles on that, where they start, but they are all going to do that to you, all right, no matter what. Now, when I've asked you, what do you hate about IFAs and pension funds? Well, underperformance. Well, like I told you, the main reason they underperform, the main reasons, they can't go into cash. Secondly, they spray and pray into a bunch of 50 to 100 stocks, when, as I've just shown you, it's a limited number, which actually are the ones going up. Why can't they just put it into a limited number? Because they've got too much capital. Why have they got too much capital? Because they're bloody good at marketing and they get paid as a percentage of the capital that they raise. So they've got so many conflicts of interest against you, you are screwed, right? Lack of communication. Yeah, they'll speak to you, what, once a year? Freaking awful. Even I do a webinar twice a week. I speak to you more often than your IFA or pension manager. So you ask yourself, what the hell's wrong with them, right? Why aren't they doing one of these every Wednesday and every Friday, right? Fees, yep, definitely is a key problem. I'd be interested to know what the other things are. Marguerite, thank you very much. Exit charges as well. Now, what's leading the way? Well, it's back to tech again. It's 22% up as a sector, so is communications. I don't gamble on sectors, and this really shows you why I don't gamble on sectors. Imagine you start in January and it's a horse race. You'd really have to gamble on which horses are going to win. Well, I don't want to gamble on which horses are going to win. What I'd rather do is pick the right stock. Similarly, when you've got style like growth, value, small cap, momentum, volatility, dividend, well, I want ones which tick every single one of those bloody boxes. So I want stocks which are a subset of a subset. Do you remember those Venn diagrams from school? I want the 15 stocks in my portfolio which are undervalued, growing with momentum and with dividends, etc. Okay, that's what I want. Over the past year, the NASDAQ 36%. What did I just show? I think I just showed a different slide. Yeah. Oh, that was year to date, wasn't it? 21%. And over the last 12 months, 36% is the NASDAQ. The S&P is 26%. Okay, and you can see it again. Delight, despair. So you had, during a 36% rise, you had about 5 months of nothing. Okay, then delight, then despair, then delight. And here's another period where you had absolutely bloody nothing for months on end, months on end. And here you spent a substantial amount of time underwater, yet there's big gains. Okay, and that's when the market gives up its gains, goes into negative territory, those are the 2 times private investors exit prematurely, because they're always trading their investments. We don't trade our investments. We spend most of the time sitting on our hands and going, baby bear, it'll come off. It's taking its time. I'm afraid that's the way it is. And that's what. Just look at that. Okay? Don't be stupid. FTSE 350, 350 largest companies, that's what they've done over the past month. Well, in Britain, it's a card company, is our Nvidia. Moonpig, there's a lot of people sending me birthday cards. That's why Moonpig is doing so well. So S&P 500, rising monthly MACD, rising weekly. This is good. I'm glad I've got 3 times leverage. If I didn't have it, I'd buy it today. Okay, July over the last 6 years has always been an up month. Looks like it'll be again. And the average return is that. So seasonality is bloody amazing. All right. But why do I also like it? Because in an uptrend like this, the peak to trough drawdown, DDD, drawdown, peak to trough is small and the duration is short. So short in duration, small in size. Any falls are small in size, short in duration. Write that down. Small in size, short in duration. S&S. As long as you've got S&S, small in size, short in duration, that's a preferable investment than one which has falls which are large in size and long in duration to recover. I know. It takes me so long to state the bloody obvious because it always does. When you're stating the obvious to people, it just doesn't even occur to you that, oh my God, I'm stating the bloody obvious. I shouldn't have to state the obvious. Okay. So that's where we are with that. Now, let's continue. There's a lot to cover. NASDAQ, very similar. Rising monthly. I love it. By the way, these are all free on, you can do these charts for free on TradingView. I'm not affiliated to them. I never met anybody from there. All right. That's the 1 month. These are weekly bars. Okay. You can tell that because it says weekly. And this is weekly because it's based on that price. But this is monthly. And I look at the monthly. You can get rid of the weekly MACD if you wish. NASDAQ got 3 times leverage. If I didn't, I'd be happy to have it at the moment. Anyway, now its drawdowns tend not to be as short or small in size, and the recoveries tend not to be as short as the S&P. Pretty good, but, just be careful. Oh, I thought after the election we might rally, but no, it looks like it's buzzing off as it often does. It peaks, and you think it's going to break through and score and win. It's a bit like the England football team, who I hope win. It goes like that and lets you down. Goes up, lets you down. Goes up, lets you down. I'm not saying it's going to necessarily do that. The weekly is certainly falling, so might not be as great as we thought. I really thought there'd be more of a relief rally after change of government, but not so. Top 10 S&P 500. That's why I don't go by what I think. I go by the data. Price 1 month ago. These are the ones which have gone up the most. We're going to have a look at these just to make sure we're not missing anything. Okay. Tesla. Now, yeah. Could you put it into a special situation for us? Well, like I said last week as well, looks like it's bottomed for sure. And if you wanted to get in as a special situation, the monthly MACD hasn't quite broken above the moving average. So be careful because it sometimes does that, then falls back. So do be careful. But if you're more risk loving, you'd already get in, as did my one of my followers, as I showed you his portfolio earlier. You'd get in like this chap did. He actually did 2 times Tesla, as you can see there, 2 TSL, but that's really high risk. And if you're more risk averse, you would wait for the monthly MACD to move above. It meets our value growth income, so it's not too bad. Arista meets value growth income at 7. It needs to be 7, 8, 9, or 10. And by the way, here's an important thing. Project forward and make sure that in 12 months, that return is worth it. If it's 40% or more, it's worth it. If it's less, then you probably don't want to do it. The problem is it's overbought. So if you do want to go in, even though on 7th of June, Citigroup said, yeah, buy, Bank of America said buy, Morgan Stanley said buy, Barclays said buy, all of these said buy. I don't care what they say. What I care about is, well, that's a bit high, but if you want to go in because it's a value growth income 7, 8, 9, that's up to you. But remember the exit rule. If it drops X, sell Y. Okay, so X might be 10%, you sell 50%. If it drops 25%, you sell 100%, and so on and so forth. Just be mindful that in upward trends, what you always want to look out for are 2 things. 1, what's the drawdown depth and duration to recover? Is that too much for you to bear? Always assume Sod's law, and it'll happen as soon as you buy into it. And secondly, the projection. 12 months from now, can it give me on the current direction 40% return? If it can't, then get the hell out of there. Broadcom's another, same as the last one. I won't repeat myself. Good. Okay. Adobe, and this is the thing about tech companies, and that makes people panic. Oh, Alpesh. Oh no. And then V-shaped recovery typically happens. Looks fine at the moment, but this is far more volatile than most people might want, because look at those drops. Okay. And they might as well also long periods of sideways moves. Not for them. Fine. Then stay away. If in doubt, stay out. Corning, new to the show, doesn't meet our value growth income. So if you're purely looking at momentum, which is up to you, and that's high risk, then this would meet your criteria, but it is high risk. And don't forget, it's below $100, which makes it even riskier generally. Corvo, value growth income is fine. Bit of a slow climber, bit of a sort of which again, you might think, oh God, not for me. Thanks very much. Just project that forward and you see that you're actually, are you talking about in a year 40% return? Okay, it's okay. I'd be happy with it. You might not. I would be happy with it. You might not. Fair Isaac 7, great little trend. Can it give you a 40% return if you project that forward into 12 months? It's overbought. You might say it's overbought. I don't want it. The projection doesn't give me 40%, and I don't like in an upward trend it can drop 36%, because then you should expect that to happen again. If you don't want to hold through that, then you shouldn't have it. So it might not be for you. Okay, FedEx 7, it's going sideways. It's all over the shop. It looks ugly. It's like, what the forget it, leave it. Skyworks, again, it doesn't even meet 7, 8, or 9. Supermicro, now it's been a good one for us. 7, overbought now, but look at those drops. That's 28%. Doesn't look like 28, does it? And of course, if it continues in that, it'll easily give you a 40% return in a year. But your concern at the moment is that that's overbought. So you could end up nursing a sharp pullback, which, as long as you're fine with that risk for that return, it's fine. Costco continues ever onwards. Overbought, doesn't meet our 7, 8, 9, which you could overrule me on everything if you wish. It's entirely up to you. And July does tend to be a good month for it. So entirely up to you. Apple, you know my view if you're in the program, and my holdings and my leverage, and you know with Amazon as well. Sorry, I'll share the chart with you at least, but you know what my views on Microsoft are, and my holdings, and my sons and my wife's, and mine, and Meta, and my sons and my wife's, and you know all of this and what I've been doing. Okay, so we come to Bank of America, which again, not one I hold, but you can see there are many stocks we don't hold, which just keep going up and up and up because it doesn't meet our criteria, and that's fine by us. Netflix, I've been covering since that period here to point out to you, I can't buy everything, and this is one I didn't buy either. Do I regret it? No, because I can't buy everything, but yeah, in a way, yeah, great. It's got great returns. It's gone up 70% since I've been covering it, and it was the monthly MACD. Well done. Walmart, it's an 8, but it's overbought like so many. So if you do get in, you're getting in on the basis that you appreciate that risk and use the same exits that I always recommend if it drops XLY. Tesla, I've covered. Berkshire, now, looks overbought. It's not going to be a sort of Nvidia, so not for me, and it doesn't meet 7, 8, or 9. Neither does Eli Lilly, however, it has in the past. And so if you're already owning it, you continue holding it. Obviously, all of these people love it. It's overbought, so same exit rules. But if your entry rule is, well, I don't care if it isn't 7, 8, or 9. I don't care if the MACD is overbought. I'm just going to use a simple trailing exit rule. If it drops X, I'll sell Y. What should X be? Well, it should be more than 16% because it can drop that. It should be more than 19% because it can drop that. So maybe you'll say if it drops 25%, I'll exit it. But until then, I'll just keep holding it. Fine. Walt Disney, Baby Bear, because the MACD isn't falling. So you just wait. CVS. That's a declining one, but what you would do with that is, well, has it dropped your X? In the past, 27% is a common, so you might say, well, as long as it doesn't drop 30%, I'd hold it. If you don't like those kind of drops historically, then don't buy the stock. Block, well, any falls, Baby Bear, it's sort of going in that direction. Charles River, Mama Bear, in other words, falling MACD, but hasn't crossed below its own moving average, so you just wait. Columbus McKinnon, that is still not below, so it's a mama bear, so you still wait. It's the kind of falls it's done before. If you don't like 27% falls in a stock that you've seen historically, well, don't buy stocks like this. Very simple. Molina has already fallen below, so that's a daddy bear. But you may still say, well, no, wait a minute. Such sharp falls are common, so you'll hold. perfectly fine. If you're risk loving, you'd hold. If you're risk averse, you'd get out at the first sign of that happening. Okay, the daddy bear. Akamai, similar kind of story. What you would do with this is say, if you're risk averse, I'll get out at the first sign of trouble, which is the MACD falling. If you're more risk loving, you'd say, well, hang on, the weekly looks like it's going to go up. This is a volatile company. How do we know that? Well, bloody hell, look at that. Look at those falls. Look at those falls. So you'd say, well, it's a pretty bloody volatile company. I think I will wait. Okay, simple with those. Don't forget all of this and my campaign for $1million.com. I want to come back to some of those big mistakes and some of your questions in a second as well. Let me know any questions you have. This is your due diligence checklist. Now, people wrongly think, oh, what's the holy grail? Shh, shh. Is it PE? Is it PEG? Is it price to book? Is it price to sales? Is it discount cash flow? Oh, if you use price to earnings, it's fine. If you use price to book, it's fine. As long as you've got some valuation measure. Growth, year-on-year sales growth, year-on-year earnings growth. Earnings is the same as profit. Sales is the same as revenue, and year-on-year cash flow. You want some dividend yields. Valuation is twice as important in moving stock prices as growth. We know this from the academic research and literature, and income is twice as important, is half as important as growth. Momentum, a lot easier buying for rising MACD on the monthly, and stochastic, you want a high, you want low volatility below 20% ideally. You want to avoid penny stock companies worth less than maybe $500 million. And you want a high alpha and high Sortino. Okay. This is the other big mistake people make. They don't know this. Really simple. And if you don't know mummy, daddy, and baby bear, then you end up exiting prematurely. If you have a premature exit problem, then consider this image. Keep a picture of it. Now, the other one is paralysis through analysis. They think the stock market is physics, so that, or mathematics, that 1 + 1 always equals 2. No. What actually happens is you will, in any year across your holdings, let's say you got 15 holdings, you will get a few which get 200%, 300%. I wish they could all be like that. You will get a few where you've got to cut the losses with, say, a 25% loss in those. That's why you divide your money into, say, 20 stocks, 5% each. Although in my quality 5, I often have up to 3 times that 5%, i.e. 15% in those. The quality 5s are the 2Ms and 3As, Meta, Microsoft, Apple, Amazon, Alphabet. And then you'll have a whole load in the middle. Now, why can't you just have these, Alpesh? Because I don't have a time machine. Okay. This is 2020-21. We had some which were here, and then we had some which, actually, I think in 2021, there might not have been any which had to exit, but most years there would be at least 3 or 4 which just have to exit, and the rest are down here. And it's these big ones which give you the returns of your 40% in a year with tailwind, at least 40% in a year with tailwind, and a year with headwind like 2022, 0% because you're holding cash. You've got to have an exit plan, 12 months, and then reevaluate. You can't just buy and hold forever, as I've already shown you, because you'll lose 6 years worth of bloody gains. And a simple rule could be, if it drops X, sell Y. Okay? He works in asset management, that guy. He's picking stocks. You're looking at too few stocks. You're looking at just UK, just growth, just value. Well, if that's what you're going to do, you're going to find rubbish because you're looking at too narrow a gene pool. I look at 10,000. All right? You're paying more than you realize to fund managers. Well, the Financial Times has just shown you an article today on that. Here's an example. You're paying 10% to be kicked in the teeth. This is from 91. It's one of the fund managers that is common and popular. £10,000, 5 years, you're paying £1,000 in fees. That's 10%. Yes, you're paying 10% in fees. You thought it was 1% or 0.75. No, it's not. They're not telling you the truth, and they want to do that based on an average return each year of 5%. Well, I get 4.9% on an instant access bloody bank account. So they're just giving you a bit better than the bank, which I've had some people say, well, that's all I want, Alpesh. Okay, that's worrying. Okay, what's worrying? Look at that, what I've highlighted in yellow. This came to me in December. My employer put me in legal and general, 20% growth in 10 years. I've been following your weekly report. I've been very limited fund, but I've seen returns around 20% this year alone. Yeah, because for all the reasons I've mentioned. You can get the transparency of knowing what you're buying, so you're happy with it. You can hold cash if you need to as well. So is 40% realistic? Well, no. Only if these 9 conditions, forget the 10th one for now, 9 conditions are met. If there's a market tailwind, which hopefully every 7 years, 5 years will be tailwind, high Sortino, high alpha stocks, high average returns, doesn't guarantee returns, but should help. Not UK, not emerging market, US only, I'm afraid, because, well, you look at where the returns are. I'm not going to put my money into Vietnam in the hope that the IFA will be right about Vietnam. Sorry. Thank you very much. If I wanted to gamble, I'll go to Vegas first. I love Vietnam, by the way, but I'd rather go to Vegas. If you can go to cash in bad years, if you can't go to cash, you're screwed. If you monitor once a fortnight, just in case anything's fallen, you can clean it up. Okay. If good years make up for bad, obviously, stating the obvious, cash return capital invested, that's the Goldman Sachs 30% formula, which I'll show you in a second. If you hold for 12 months, then reevaluate, sell anything which drops, i.e. if it drops X, sell Y. Okay. Simple as that. Then you might be fine. How did we do last year? Well, last year will be a year we'll never repeat because the market was up 25% on the S&P. It was up 55% on NASDAQ. That's why we had ridiculously high returns, which we might never get. But let's say the pension goes up 80% in 1 year. Well, fine. And every other year, you just do bank interest. Great. So your pension was like this, jumped up, now it's like this. Great, fine. Actually, what you really want is that every few years, nothing. Every few years, big leap up. That's it. That's probably what will happen. Well, wait a minute. Why have you got some really massive outliers? If you take exclude your outliers, like if we get rid of all of these stocks except just Tapestry, then we'd be down 1.6. If we get rid of all these stocks except Nvidia, then we'd be up 238%. Honestly, I do get some people saying that. They're going, well, if you remove all the good ones, you're left with Tapestry. Yeah. Well, wait a minute. If you use the same criteria to pick all of these, why have some done so much better than others? And by the way, it's not just the Tech 5. All right. There are others in this. So let's say you said, well, no, you're not allowed to have Nvidia, Meta, Tesla, Amazon, Alphabet, Microsoft, Apple. Fine. You've still got Sterling Construction at 168%. You've got a 55, a 48, sorry, a 36, a 30, a 26, a 22. I'll take that as well. Thank you very much. Okay. But last year was an exceptional year. 2022, 0%. Assume you plan to invest over 10 years, and let's say you make 20% per annum. Let's say you even do 15, you double your money in 5 years. Let's say you got 100K and you add 1.5, then that's $1 million over 10 years. It's $1 million over 10 years. And you want the transparency of having the data. You want to make sure you got the data in your hands, and you want to make sure you pick the broker and you pick what you invest in based upon the data and the knowledge. Stop paying away fees to fund managers with conflicts of interest and IFAs with conflicts of interest. It's a killer. Never mind what that chart shows. And like I've always said, you can beat these bloody fund managers. That's probably the biggest overt, audited example of bloody well doing it. Okay, over a 12-month period. But I've got loads of others. Just go on my LinkedIn and you'll see tons of them. Okay. The UK's largest private investor software company has been auditing my annual picks since 2004, right? Because when I set up the hedge fund in 2004, retail clients can't invest in hedge funds. So I said, I'll continue for free, giving every year my 12-month picks from January. I mean, I can do it in July for 12 months. I can do it in August for 12 months, but January, because it's the start of the calendar year, for them, for free. And they've been monitoring those. And I said, I'll do it with just UK stocks since 2004. And that's generated on the UK alone, because they look at it and they publish it at the start of every year. 20 years now, that's generated 18% per annum. UK stocks. Well, what about US? Well, what do you think? How's America done over 20 years compared to the UK? And by the way, the UK markets over that period, slightly above 0% return. 15 to 20 stocks. This is why. Past and present paying clients. Barclays did my book launch. Thank you very much, Barclays. Who am I? Well, I've written everything that I've told you in all of those books over the last 30 years. I know, I'm old. My first book came out in 1997. I started writing it in 96. And I started pitching it in 95. So we're coming up to, we're 29 years since the first pitch. And they're Financial Times, most of them. This one was sponsored by Bank of Scotland. But most of them are either Wiley or Financial Times or Palgrave Macmillan. It's not self-published. All right. Croakey from Goldman Sachs Wealth Management. I'm going to show you how to get the data in a second and do this yourself. Croakey, 30% per annum. That's what you're getting on Croakey. Okay, if it's in the top quartile, companies with high cash returns on capital invested generate 30% per annum returns. Not every year, and it's not guaranteed for every stock. That just sums it up. But when Goldman Sachs, and I stole their research on this, because when I set up the hedge fund, I got invited to a dinner with them, a lunch rather, with them and Jim O'Neill, Lord Jim O'Neill, and I took the slides. Okay, this is the R&D from their quantum database by Goldman Sachs Research as part of their investment research team in Goldman Sachs Wealth Management. And what they discovered, and you'd expect them to do this because that's what their R&D does, new ways of making money. And it has to be high. Otherwise, who the hell's going to give their money to Goldman's? All these super rich people will say, bugger you, if you're not getting me 30% per annum. This is why rich people get richer. I'm sorry to say, it's not because of the government. It's despite any government. They get richer because Goldman Sachs Research and Development Department is getting them 30% per annum. Not every year, not every stock. Okay, it's not guaranteed, but because you can see 2008, nobody did it. Some years you get more, some years you get less. That's what gets you the 30%. That's them. So I knew I had to tick the bloody Croakey box. Why? Well, because if a stock falls and I haven't ticked the Croakey box, I'm going to feel a bit of a bloody idiot. And really, a lot of it is about making sure you've done your due diligence so you don't feel an idiot. All right? Simple as that. So, look, that's why rich people get richer. Oh, if you got 50 million, you can get access to that because Goldman Sachs will give you and pick stocks that way for you. It's not because they're not being taxed heavily enough. They're getting richer because they're getting richer doing this. When you tax them here, they'll just move it somewhere else. Guess what? Goldman Sachs are everywhere, including in the Cayman Islands and the British Virgin Islands. Funnily enough, this is a typical portfolio I get sent from people, and you can see the massive gaps in green. There's very few greens. You need these first 5 columns to be green. It's like it's an anemic patient, and then they wonder why they're performing so poorly. Each of these funds, hundreds of stocks in each individual, the ones which aren't bonds, and then a few stocks. I mean, that's typically bad portfolio with massive poor performance. For that reason, just spray and pray. Peruvian Dolphin, another one I get negative comments about. Stocks spread over 1,000 different companies in a scattergun approach. Fisher Investments have approached me. Well, they'll just do the same. They want to put everything into a single fund. I bet they do into theirs. Ask them how did they do in 2022. Ask them, can you ever go into cash? Ask them what a Sortino ratio is. All right? I'm going to show you something now, what my ambitions are. From hedge fund to software, that's the software. Software, it's basically the holy grail. It's showing you the data. You need data. These are people who've worked for me. This is stuff you can learn, in other words. Kirsty had no background in finance, worked for me as my assistant for 2 years, straight out of university, is now a pensions lawyer. Naomi worked for me straight out of university, background in English literature. 2 years as my assistant, now manages 10 billion at Polar Capital, used to be at Newton. Kanira worked for me out of university, engineering degree, more than 2 years, about 5, now in venture capital. Susan, global head of communications sponsorships at Wells Fargo, worked for me as my assistant, I think only for about 3 to 6 months. So I can't really take too much credit for any of their success. But the point is, anybody can learn finance. Anybody. And none of them, by the way, had a background in finance. None of them. All right? And the bit of finance you can learn is not the quantum mechanics, it's the investing side, right? It's teachable. It is game changing. And I think it's worth people knowing. And these are the people who come to me and say, can you do this? Can you do that? And I say, no, I don't want to manage your portfolio. Why don't you learn to do it yourself? It's really bloody easy. Okay, I'm afraid I'm a bit right wing when it comes to investing, which is I want you to take responsibility for your portfolio and your pension. Okay, is mean reversion and capitulation the same? No, there's an overlap between the two. Now, that's what I wanted to give people, Because I said, you know what, we can turn the asset management industry upside down, like Uber turned the taxi industry upside down, like Airbnb just invented a new thing. I guess they turned the hotel industry upside down. Well, the asset management industry, come on, look at it. The pension fund industry is absolutely ripe for turning upside down, because it is ridden with Muppets. And my way to do it is do two things. One, provide you all the data, but data is just a load of data. Two, give you tutorials with me. Three, so not two things, three things. Three, not charge you ongoing fees, because that would be a conflict of interest, because then I'd have an interest to say, oh, no, please put more money in. Please, no, you should do this. No. Okay, not charge ongoing fees, give you lifetime access. Why? How can it be scalable, though? Well, it's very simple. For the first 300, it used to be 250, but I can easily handle 300. For the first 300, I make sure that I will always be the tutor. Then we'll have other people around the world teaching, but for new ones. But for the first 300 charter members, it'll always be me for life. And there'll be no ongoing charges. For future people, there would be, after the 300, other teachers, other charges, other subscription costs. Somehow we'll have to work it out. But for the first 300, it wouldn't. When we got all this good comments from the BBC and from chairman of the Chicago Board of Trade and hedge fund managers and Merrill Lynch and American Express, that was definitely the way to go. And then we trialed it on private investors and did video recordings, because their comments were so bloody good. I said, you know what, I better do bloody videos on this, because otherwise people aren't going to believe it. alpeshpatelreviews.com, and you can see the videos. If you do want to be part of it, please go there. I think we're changing the asset management industry upside down as well. I'm going to answer some more questions. Is the SPY and QQQ usually rebalanced at the same time? I don't know. Ask ChatGPT when they're if they're rebalanced at the same time. And it'll tell you the answer to that. That's where you go if you want that. I want to share with you some other documents as well, actually. I'm going to do that. I'm going to share some other documents with you as well. I want to answer any questions that you might have, go back through any slides. By the way, on the webinar, I do a 40% off for that. I want to get to about 300, then get venture capital investment, then go even more global. We currently have clients from New Zealand to Canada. And one day, maybe float it and replace St. James's Place. St. James's Place has 900,000 clients who are miserable, except two. There's two who aren't. Okay, two have come on my TikTok to say I'm not miserable. One's related to the founder, or one of the founders, probably. But they've got 900,000 miserable clients. We want to take all of them, absolutely every single one of them, but do something different, which is not hold their assets. Like Uber doesn't own cars, Airbnb doesn't own properties. We don't want to hold their assets. We want to give them the data, 10,000 stocks data, and the tutorials to teach them how to use it. So think of me as either a driving instructor who you use, and then you go and you keep getting used to the car, or think of me as Goldman Sachs or McKinsey. I come to you, I give you the executive summary, and you say, well, I want the data behind this. And I say, here's the data. And then you say, well, I don't just want the data, I want to understand this. Then you go, oh, right, I get it now. That's how to look at it. We have a data team. We have a graphics team who puts it all together, and then I curate it. What happens if you fall under a bus, Alpesh? Well, don't worry, it's a company. So I have a vice president. If President Biden, should be removed by an act of God, there's a vice president who takes over, who knows exactly all the stuff. Plus, we have it all online. Okay, so because we have it all online, you can always hear my voice. The one thing you'd miss is seances with me. But you would still get all of that education anyway. So even if I fell under a bus, you'd be fine. The database and the calls are the two things people said they wanted. Any questions other than, are England going to win? Returns, if the education improves a 100K portfolio by 10%, then that's a 10K return. On a £1 million portfolio, that's a 100K return. As some people said, it's a bloody no-brainer. That's my goal, to make it a no-brainer. 100K 20% return on a 500K SIP or ISA is a 100K return you make. 100K. 55% was our 12-month return to November 2021, which was good. There's the links. If you would like, I hope you will. I'm going to answer some questions. Thoughts on IBKR launching contracts that allow people to wager on future events related to the economy and climate? You could just use Ladbrokes for that. It's not a new thing. It's been around for ages. Contracts on events. Ladbrokes. They're just getting into the gambling industry because IKBR, Interactive Broker, is an American company, and they're not allowed to. There's limits on betting and gambling that you can do. So yeah, my thoughts are great. Makes business sense for them. Might not for you. Hello from Angers. Where's Angers? Angier. Peter. Yep. Let me know if there's anything I've missed, any questions at all that I might have missed, because if there are, then I want to answer them. Okay, then I want to make sure I've answered them. By the way, I call it the Great Investments Program because we're looking for great investments. That's the process. The closest to that is you. The DIY, do it yourself, is you. And you've got a couple of red crosses, which is my job to remove. The IFA is the absolute furthest you could possibly get from quality investing, and the fund manager is the second furthest. You could get the conflicts. Again, the Financial Times have shown it. Gambling is not exactly, Peter. So yeah, wagers on, and you use the word wager, which is synonymous with the word gambling, on future events related to the economy and climate. They're just getting into the gambling industry, which is fine. What we're trying to do by removing overvalued companies, rather low growth companies, companies without dividend yields, companies which might have poor alphas, poor sortinos, is what we're trying to do with all of that is ensure that we're not gambling, because the less blind spots you have, the less you're gambling. I mean, if you cross the road with your eyes closed, where you're taking in no information whatsoever, then for you to get across, it's a gamble. So how come it's not a gamble every time you cross the road? Because you looked in both directions, you took in the information and the data, and you said, well, if I look both ways and I walk slowly and I listen, look, okay, and look again. Remember at school, right, left, right, whatever it was, left, right. And I tend to go like crazy when I'm abroad because you never know which direction the bloody cars are coming in. And then the cyclist, and then the motorcyclist, and then the head-on in front of you. You're not gambling. Or you're reducing the space for gambling. Of course, something could fall from above, which sometimes it does now and again. Gambling is where you go with your eyes closed. And so many people just go with their bloody eyes closed. It is ridiculous how many do that. Okay, any other questions? If you're saving, say, 1K each month, would you buy into the same stock you already hold for the year? Always look for new ones, or a bit of both? It's a good question. There's an element of bureaucracy. There's an element of, well, actually, if it's a good company already and it's doing well, then why not buy more? There's also an element of sort of a variation on dollar cost averaging. Well, if it's falling, why would you buy more? Unless that was your plan all along, because let's say it was Microsoft. So the answer to that is yes and no. It depends. If you want to increase bureaucracy and you don't mind, all other things being equal, then you'd pick a different company because at least you've got lots of different companies. If you just wanted to buy into one, there's a higher risk, of course, because you've only got one stock. And if it's falling and you're still buying into it, then that's really high risk. Okay, so personally, I'd probably say do a halfway house. First 3 months, one company, or only ones which have gone up. Okay. Can retail investors view where most stop losses are set on a particular stock? No, brokers, I don't think, tell you that. Okay, I'm afraid I don't think brokers tell you that. Let me just turn that off for a second. Yeah, I'm afraid they don't tell you that most of the time. Any other questions? If there's anything I've missed at all, please let me know. Otherwise, I'll assume there isn't. And I'm going to just share. What I like to do is go through these slides in reverse order, just so in case anybody at any point says, oh, I missed something. Okay, so, and it might trigger a question. So I'm just doing it in reverse order. So let me know as well. For those who have joined, thank you very much. I will send you the next step is I send you an onboarding email. You have a call with me, with my team, make sure you've got access to everything. And then we have our first tutorial to teach you how to use it. I only need one usually to teach people as well. Thank you, Marguerite. Thank you, Noel. Thank you, Peter. Rashid, have you published your thoughts on what you expect the market to do post-election? Which election? The US? No, I haven't. this is it. What I expect to do post-election, this is it. I mean, I don't need to look that far ahead. I continue following stocks based on value, growth, income. So I don't care what happens post-election or pre. I'm not gambling on the election. What I've found in my experience of writing all these 18 books and dealing with retail investors is they have a high tendency to want to gamble. And it's like you try and drag them back and say, look, stop gambling. And they just want to go, no, I want to gamble on what's going to happen there. And I think this is going to do well. I didn't know AI and NVIDIA was going to be one of my best picks. I didn't know. If I did, I would have only bought that. I didn't even know it was in AI when I bought it because it just, the numbers made sense. So we got into it like any other company. So does that mean I'm lucky? No, it means we just followed the process. Value, growth, income, cash flow, Sortino, alpha. Okay. So how come it went up so much if you didn't know it was AI? Well, actually, I thought it was making graphics cards for crypto mining, and people were into that. And that's where the numbers were coming from. I looked at that ex post facto, like we did on my Bloomberg TV show. We'd look at the markets, what happened, then we'd read the news and we'd say, oh, the news is why the markets moved. After the event, we didn't try and predict stuff, but the numbers were good. It was undervalued. The rate of growth of earnings and profits, dividend yield, Sortino and alpha. Okay, it was simple as that. It was these numbers for NVIDIA. It wasn't any narrative story. I haven't got the time to read a billion stories. That's why I prefer investing this way. It's a hell of a lot easier. Okay, thank you, Adam, as well. Thank you, Carwin, as well. On that. Now, there'll be people who love gambling on, well, I think this is going to happen. Interest rates will go to this. What do you think will happen with interest rates? Those are people who will come to me because they think I'm going to tell them, oh, you might find some oil over there or over there. No, that's not. I'm not in the gambling business. I'm in the information increasing business. So I've got as much information on the companies as possible, which removes all the bad stuff. And a lot of the good stuff gets removed as well, I'm afraid. I throw out the bathwater and a load of babies with the bathwater, but I want as little dirty bathwater in the bath, as long as there are 15 to 20 babies left in there with as little dirty bathwater as possible, I'm happy. I don't care how many babies I've thrown out with the bathwater, though. Do you see? Whereas people think my job is to separate bathwater and babies. It isn't. I mean, there's a subtle difference. And people don't quite understand that. Okay. Thank you all. I think that's everything for everyone. Everybody who's joined, I'm going to send you a sign up in a second. Thank you all very much. Oh, let me go do this. Thanks, everyone. And I will speak to you all soon. Continue sending me emails if you wish. And yeah, I look forward to speaking to you all very soon. Thank you.